Hi, guys, and welcome to the 41st episode of the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we look at a picture of the S&P 500. The red arrow here denotes Monday, the 25th. Tuesday, Wednesday, Thursday, and Friday. Well, during the week, we made new highs on Thursday and then gave it up a bit on Friday. Market's still in a very bullish mode. Let's begin, as always, by talking about the technical picture. And as you can see, nothing has changed. This is, it's the end of the summer. Everything's over, and we're in massive bullish mode. Okay, it is the technical picture is super bullish. Nothing has stopped. Nothing has changed. Okay, let's get rid of this arrow. We don't need to put it anymore. But this is the week that we're talking about. So bullish picture. Nothing has changed. We ended down on the month and on the summertime, but the bullish picture is still intact. Okay, so let's move on to the sentiment. Has anything changed? Well, we usually look at the CNN Fear and Greed Index. It's at greed. Okay, we talked about that. It's still pretty good. We still have more room to go higher. What about the AAII sentiment? Now that finally came down from last week's crazy 44 print. I mean, these prints were happening, like people were getting more and more bearish as the market was going up. So finally, is it strange to see that as the market is going higher, we're getting less and less bearish? No, we should expect to see that. However, we're still way below the neutral or the historical averages for the bullishness and bearishness of this survey. As you can see, 37.5% is average. It's an average reading, and we're still below that. And even though the bearishness went down, it's still fairly high because 31 is the average. So we still have plenty of fuel to go higher. Okay. So the technical picture is bullish. The sentiment analysis is bullish because it's contrarian. Because when you have people who are still bearish at highs, that's the wall of worry that we kept talking about. So bullish picture, technical picture that is, and that's it. There's nothing more to say. Let's move to the macro. We had a couple of macro prints this week. The first being GDP. Q2 GDP came in at 3.3%. I think they were expecting 3% or 3.1%, something like that. So it beat. It was higher than what they expected. And this is big because the higher the GDP, the economy is doing well. There's nothing that's crashing. So what does that do for rates? Well, rates are going to stay higher for longer. I don't know why the Fed is going to cut. I have no idea why they're cutting in September. Let's see what the Fed Watch tool has for us. Okay, 86% cut coming in September. 86% of a cut, market at highs, and what does the US 10-year yield tell us? Up. Still hovering at the highs. Yeah, down a little bit, but it's up on Friday. So it's at 4.23%. You'll see why. Because inflation is still higher. Okay, so we'll see. The next thing that we talk, so GDP, very good. Okay, very well. People are freaking out because tariffs are supposed to be inflationary, and maybe they are, and we've seen that they are a bit. But GDP is doing well. So why cut rates? I don't know. Okay. Let's go to the next thing. Initial claims. We always look at initial claims because we want to see this as a leading indicator to, when there might be trouble, people piling into unemployment. Well, initial claims went down to 229,000 for the week. Last week was 234. So we were expecting it to go up. If there were bad times, it actually went down. We're in the clear, nothing to worry about. Okay. And the final thing that came out in terms of our macro this week was the PCE inflation figure on Friday today. This is the Fed's preferred inflation measure, so we should take it seriously. And what did it come at? 0.3%. What were they expecting? 0.3%. Looking at the core PCE. Okay? So the core PCE came in at exactly as expected. Still fairly high, 0.3% growth in July. Still pretty high. Okay, so it's not like inflation is coming down, negative prints. So yet again, why is the Fed cutting? There's something else is going on. I mean, if you're going to cut, 86% chance to cut, with inflation still fairly high. I mean, it's still above your 2% target. And initial claims are pretty good. There's nothing really damaging here. And GDP growing, I mean, you're in the process of, like we said last week, a melt-up scenario if you cut at highs. So let's go back to the SPY here. So that's what happened for our macro. That's all we have. So it's still fairly bullish macro, okay? So now let's talk about things that interest me or pique my interest. This is our third segment topic, things that interest me. Okay. Now, we mentioned things that should be noted. We mentioned last week that, or during this period, that the market's going up, it's making new highs, but the RSI, the technicals, are making lower highs. This is called negative divergence. And I mean, we had a second bout of negative divergence coming in this past couple of weeks, because we had a high here that marked around the August 14th high here, and the RSI was lower. That's what made the first negative divergence print, and now we have a second negative divergence print. I mean, we got higher, and the market's going down, and the market's up, and the RSI is going down yet again. I mean, this could get blown away if the market continues to rip higher and this continues to go up. It'll just negate the negative divergence playing out in the technical charts. But we'll see, okay? This is a note to be worried, because this is why I still have my shorts on. Okay, I still have some shorts because of this negative divergence is still happening. It's still an ongoing feature that hasn't been solved yet. It hasn't been, we don't know what the outcome is of that negative divergence. It hasn't played out yet, okay? And we're looking for that. However, I don't think that we're going to crash. I just think that we might be heading into some turbulence going forward. I'm still bullish because the technical picture is bullish, and so is the fundamentals. However, you shouldn't be surprised if you're correct, okay? And another thing of note, so we have like negative divergence is the first point of interest right now. And the second point is that we're entering a period from now till October, okay, since here, this period right here, the next couple of months, is very bad in terms of seasonality. So we're heading into negative seasonality with negative divergence playing out in the chart. So you should have short exposure, okay? Because of that. So we're entering a very bad period in the market right now, okay? All the way till October, these two periods, all the way to the end of October actually, so it's actually these 2 months coming up are very, very bad seasonality speaking, okay? It doesn't have to play out like usually in the summertime. We usually get quiet summer, but we had a huge long rip in the summer. So you don't know, okay? So, just put that in the back of your mind. Keep that in the back of your mentality, because, we're having record highs. Our portfolio is at record highs. But, the negativities, the negative seasonality and the negative divergence is still in play. Okay? So we have to keep that in note. So I figure since this is the end of the summer, and we had our predictions going into the summer from May, June, July, August. And let's do a recap of how we performed during this summer period, okay? So the first thing that we said is that our first scenario for going into the summer was that it would be a choppy sideways market. We might go up, hit the highs, go back down, and then maybe chop around before breaking to the highs later on. So I was thinking that the first case scenario was going to be a choppy scenario, although it should be net long. Okay, and that's why we had shorts going in. The second most likely scenario was a low volatility drift upwards, which is what we got. The second scenario is what actually played out. Okay, and they were fairly close. However, I gave the edge to a sideways choppy pattern in the beginning of the summer months, but it was very close. The second scenario of a slow vol grind higher was very close. Okay, so regardless of whether we had the first or second scenario, you should have been net long with some short exposure, because the short exposure was because I thought it was going to be choppy, but you should still have it even on a low grind higher. Okay, and there are ways to enter short exposure without losing money on your shorts. Okay, but that's an advanced topic that we'll talk about maybe later. Who knows? Okay, but because there was a likelihood of a sideways choppy market or a low vol grind higher, you should be net long with short exposure. The third scenario that we had in mind that was completely a low probability event was another crash. Like, this tariff crash here, we were thinking that was going to be another crash, and no, we put a very low probability to that. That's why we stayed net long with short exposure. Okay, we didn't even get to the neutral stage. We were net long always with a little bit of short exposure. And that's exactly how it played out. It played out net long. The short exposure didn't really hurt us that much because it was a very small percentage of our portfolio, 2%. And our net longs paid off. Okay, so we were pretty accurate in predicting what would happen in the summer months, and we took full advantage because our portfolio is at highs. So we took full advantage of it. The next thing that we recapped is that we should be overweight gold and gold miners. Okay, so how did gold perform? Great. These are the summer months, May, June, July, sideways pattern. I was saying from the beginning of the summer, we said that I would be happy if gold had a sideways consolidation and stayed above 3,000, which this is the 3,000 mark. Let's mark it so that we can see. Horizontal line at the 3,000. Okay. This was said in May. When we were around here, we said that I would love for gold to stay sideways for the entire summer, maybe drop to 3,000, as I was expecting it to drop to 3,000, because during the summer months, historically speaking, the seasonality is very bad for gold. It's usually choppy, doesn't do very well, okay? So I was hoping that it would go down to 3,000, maybe pick up some gold, some extra gold stocks, but it wasn't to be. It stayed high in its formation, and it went down from an overheated condition in terms of the technicals and the RSI to flat, and now starting to go up. Okay, so the recap for gold was great, and now gold is breaking out above this 34.45 level. Let's say it's 34.35 actually, but it's arbitrary. It's not perfect, but plus or minus. You can see that it tested at 1, 2, 3, 4, and on the fifth time it looks like it broke out. We don't know. This is the end of the month. We don't know what's going to happen. Usually seasonality is still bad for gold going all the way to November. Okay, but we don't care about seasonality if there's other fundamental things playing. So we did very well in the gold picture over the summer, simply by it staying in a sideways consolidation pattern. And now it's built up a lot of fuel for a real breakout to take it to 4,000, which is around here. Plenty of fuel to take it to 4,000. Okay, but what was even more surprising during the summer months, and mostly in the last month and a half-ish, was the gold miners, GDX. You see, they too stayed sideways. Maybe they fell a bit in May, but they too stayed in a sideways pattern, but ripped past the new highs in the beginning of August, and have, as of this Friday, closed at a high. So the miners are outperforming the metal because the metal was sideways, and the miners are ripping in January. However, the miners are close, not there yet, but let's go to a monthly chart. You can see it better. The miners are close to their all-time highs. And we had this bubble here as my prediction back in the day in the summertime, the beginning of the summer, was we can break the highs and go to in the 70s. The highs is like 66, 67. Okay, that's the Halcyon highs of the September 11 run. And look, in this 1 month, August was amazing, 52 to 63. That's like what is it? Almost a 10-point move, almost a 20% move in a month. 10, yeah, maybe a bit less. A fifth, 20%, maybe what is it? 22% says it right there. A 22% return in a month on miners. This is what you should expect to see. However, I think this is conservative because gold at highs, this thing should rip to new highs. This should go maybe to 80, 90 even. Like if we crush it a bit, I mean, from the lows of 28 to 68 is 40. So we can go to the 100 level right here. We can actually move this as a measured move of this sideways consolidation. We can move this to the 100 level, because it's from 28 to 68 is 40. So another 40 would be 106. So let's say 105 level. This is a very realistic move given where gold is at. Okay, but that requires people jumping on board. And by people, I mean institutions first, the generalist investor, not just gold-backed funds or gold-focused funds, I should say, but institutional investors, and not just the ones that have gold exposure, but even generalist investors. And that will take it up to over 100, if that's the case. Okay, because now it's just the smart money was coming in here. The second to smart money, I wouldn't know what you call it. The next level money, let's say, is coming in now. And when it breaks the new highs, then you're going to have people come in, and then you're going to see retail jumping in as well. So GDX performing very well. Okay. So let's go to the daily chart. So GDX finishing at highs. Where's the RSI? It's highs, but even if it drops, makes keeps making higher lows and higher highs, I'm happy. Okay, so you don't just look at when something's trending, don't look at the RSI. Okay, go with the trend, forget the technicals. Okay, it'll confuse you. When something's in a sideways pattern, then yeah, you can look at the RSI and the technicals, but pretty much ignore it when you're trending. Okay, look at the fundamentals first. So yes, GDX, and this is why I don't know if I don't know how to say it more clearly, but if we go back to gold, for months, the entire year, and for even all of 2024, when it broke out of the 2,500 level, or what was it? I think it was the 2,000 level. When gold broke above 2,000, for this entire time, I was bullish. And you should stay bullish. And this summertime is when it wasn't clear, I am overweight gold in my portfolio, and gold miners especially. But not just gold miners, but silver as well. How is silver doing? Breaking out, maintain the highs, and now at new highs. Silver. It's at $39 an ounce. Okay? However, the difference between silver, it's performing much better than gold has in August. Okay? Much better than gold. And that's why I said last week that you should be focused in the silver space now, because that has the most probability, the greatest chance not the greatest chance, they both have the same chance, but a bigger chance of outperforming the gold miners. Okay. If the miners could double from here, what do we say, GDX? Let's go back to GDX. If GDX goes from 63 to, let's say, an 80% move to 100, whatever it is, 75, 80%. Silver could go much higher, double. And the silver miners will more than double. So if the gold miners could, what are silver miners? Silver juniors is SIL-J. Okay, that's the junior miners ETF. These guys, look at the monthly chart here. Okay. They're coming to the 21 is the highs. Okay? Like if we get to 2021 and we break out, this is like 40. So it's more than double. So let's go back to the daily chart. and back to silver so we can see exactly, because I like to look at the metal first before looking at the miners. Silver on a monthly chart, as you can see, has a huge double top here from the 1980s. Remember that? The Hunt brothers trying to corner silver at 50. They brought it all the way to $50. And then the halcyon highs of the 2011 bull run brought it to 50. We're only at 39. Silver hasn't broken out the new highs. It's going to happen when everything else happens. And it's going to happen in the end, and it's going to happen exponentially faster. You're going to see like 1 month, weeks, when it's going to go to like, I don't know, who knows, 70, 75, who knows. When the euphoria happens in gold, when you see GDX miners trading at 100, this is going to be trading at 75. And it's going to happen in the last 10% of the move. The thing that you have to know about gold, silver, and the miners is that it's not like stocks. They don't rip in the beginning and then go slowly over time, okay, like any other stock. The majority of the move happens in the last 10% of the move. Okay, so you'll see wicked rips in the last 10% of the move. Okay, this is why I am more excited being in miners right now than I am in general equities, like even tech, like Nvidia. I mean, look at the Nvidia move. Do you think Nvidia has already, like after the breakout in 2025, what is it? Nvidia went from 65 to 175. Okay, so like let's say triple. Okay, do you think Nvidia doubles from 174 to 350 again? This is like what from? Do you think Microsoft, all these AI companies, do you think Microsoft even doubles from 500 to 1,000? I'm looking at a monthly chart here, guys. Okay, do you think it even doubles from 500 to 1,000? That's asking a lot. A $1 trillion company will go to 2 trillion. A $2 trillion company, $3 trillion company will go to 6. It doesn't work that way. So this is why, like, this AI boom in Nvidia. Let's go back to the daily. Maybe it's weird looking at the monthly, but you have this Nvidia move. I don't think Nvidia doubles. It might, if the market really rips. But that's why I don't want to be in it, because I don't look at just a double. I mean, I think the miners could like triple from me, especially the juniors could triple, quadruple, quintuple. Some of these juniors in a big move. Well, I don't think the AI stocks or the tech stocks will double. That's why I'm underweight these and more overweight the miners because of that fact. I still have some, okay? I'm just telling you that I'm underweight. I still have some general U.S. equities. However, another thing that you should look at is that GDX versus SPY. Okay, GDX has been outperforming the market. As the market is going into new highs, it's been outperforming the market, the general market. And like we said before, we want this to be like 2016. Okay, this move where the GDX outperforms SPY by a lot. Okay, this is what I think is going to happen. And by the way, my junior miners have doubled or tripled already, and they're still undervalued. They could double or triple again 5 times, and it'll be just like 2016. In 2016, gold didn't even go to all-time highs. Now we're going to all-time highs. The miners are going to catch up. That's my bet. Okay, that's my bet. So when you have the SPY, coming into negative seasonality, when the miners outperform SPY, that means even as SPY is going down in a seasonally bad period, miners will be going up. So there's nothing, even if you're not, I don't understand, even if you're in general tech, you should like pair your gains, like cut some of those gains and put it into gold or gold miners just for the diversification effect. If the market temporarily goes down before ripping again in October, November, December, but as the market goes down, you should want to have something that will probably resist that temptation, because now everybody's going to get out of tech and rotate into something that's working. And that's, for me, I'm betting that it's the gold and silver miners. So recapping our summer, let's go to SPY. Recapping our summer playbook, everything went according to plan. Gold consolidated beautifully for the summer and just now starting to break out. Silver didn't even want that consolidation. It was going up the whole summer. Positive drift. And what else did we say? What else did we predict? Oh, we also predicted that rates would stay high, but which they are. So everything that we said was going to happen in the summertime for our like best case scenario actually happened, and our account reflects that. So great end of summer. Let's see what happens to the markets going forward. I think that even though we are probably going into negative seasonality and we might have some corrections, it should be noted that this market fell 20% this year, okay, in April. Okay, touched 20%, 18, 16, 20%, whatever. It's very rare to have another 20% drop within 6 months. I mean, I've never seen that. So you should be bullish, even if with a correction, you should be bullish after for a little while, okay? Because as of right now, seasonality does not have to play out. I mean, we could have gotten that sell-off, the selling out of your system, let's say, or the big guys could have gotten it out of their systems in April. And now they're trying to pile back on because nothing bad is happening. Who knows? You don't know what narrative is going to play out. However, you should be prepared for the market to be sort of weak into this September-October period. Okay, so let's just count the fact. Let's just pat ourselves on the back and thank God that we had a good summer. Prepare for winter coming up, fall coming up. That is bad seasonally speaking. And that's it. Trade it like a portfolio. Trade everything like you want to win no matter what happens. So that's it for the summer. Looking forward to the fall. Happy trading, guys. Later.